FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 9/4/19. Summer is officially over. Well, I had a fun weekend. I was at a wedding, and I was supposed to come back on Monday, but decided that I figured the storm was going to pass Florida, and I was just better off going home on Sunday, which I did. And then there were all these imperiled cries and everything. I'm not on the water for that exact reason. I don't think it's a wise move to be on a barrier island. But, of course, the storm never came. Yes, it hit the Bahamas so hard. It's terrible to see. I spent a lot of time in Grand Bahama Island, and just horrible, heart-wrenching. So our heart goes out to them. But we're here. We're safe in Florida. It's going up the coast. It's probably never going to hit anything. It just shows what the weathermen know or don't know. And, you know, when it comes to the markets, stocks, financial markets, sometimes your trusted advisors are no better than weathermen. They can see clouds on the horizon, but they don't necessarily know if the storm is going to hit or not. Well, we're looking at the trade war. What's that going to do to the U.S. economy, China, the world economy? And where do we stand right now? Eddie Ghabour is with us now. He's been on many times. Eddie, welcome back. So where is the trade war? Where does it stand right now?
You know, I think right now the only good thing that's happened here short term is the rhetoric seems to have calmed down a little bit. So we'll say a truce at this point in time. But we've been through this multiple times. I think the likelihood of a full trade agreement before the election is probably very slim. So if investors are expecting some type of full comprehensive trade deal to be done by November, I think that they're going to be probably sadly mistaken in regards to that. It's turned out to be, you know, which when you're dealing with the top 2 economies in the world, it's not an easy thing to tackle. And so I think to have a full-blown agreement is just not going to happen here anytime soon. And that's why you've seen the market's volatility being as high as it's been here lately, because the one concern is, you know, eventually how big of an impact will these tariffs have on our economy? I mean, right now, our consumer is strong, and we're probably for sure the best economy around the globe, but everyone around us is going into a recession. And as you well know, we are a global economy. And eventually, when this happens, if it gets deep enough, it will spill into the U.S. And then we start to have the recessionary concerns here domestically, which is why we've definitely been a little bit more cautious from an investment standpoint than I've been in many years. I've been on your show many times. I've been very, very bullish. Mm-hmm. And right now, I'm just more on the cautious side right now as we wait and see what happens, because the other thing on top of that is the interest rate market is telling us that there are some risks out there that maybe we don't see. Yeah, well, with that yield curve, I mean, God, can you believe how low the 30, the 10, the 30's under 2 years, the 10, like I haven't looked at it the past couple of days, but it was about 1.55 the last time I looked at it. Yeah, I agree. I mean, the 10-year Treasury is at 1.46 today, and the 30-year is under 2. I mean, the interest rate market, to me, is a bigger story than the stock market in regards to how much rates have pulled back in such a short period of time. That on top of the yield curve inversion, which again traditionally has been a warning sign for future economic growth, is something that has definitely caught my attention. Mm. For good reason, too. For good reason. I mean, in a healthy economy, why do you need lower rates? The economy is growing and it's expanding. So the need to cut rates, you got to wonder about. But then when you see the long-term rates go down, which purportedly the central banks do not control, and you see them go down as much as they have,
you really got to shake your head and wonder what's going on here.
FSN Radio. It's all about what's next.
Trilogy Metals is a world-class developer in Alaska's Ambler mining district. The company already possesses 8 billion pounds of copper, 3 billion pounds of zinc, over 1 million gold equivalent ounces, and now over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion with a 33% IRR. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades on the New York and Toronto exchanges under the ticker symbol TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com.
The Financial Survival Network. It's all about what's next.
Yeah, and I think this is kind of indirectly tied to the trade issue and the tariffs or whatnot that could eventually cause some additional expenses to households. And right now, I would argue what's keeping our economy afloat and the numbers looking good is the consumer is strong. But once you start to take money out of the consumer's pocket, and if that's the biggest thing that's keeping your economy going, then you have the next leg down. And so right now there's a tug of war. The bond market's telling us there's reasons to be very concerned. The stock market is telling us that everything seems to be fine. And I kind of trust the stock bond market right now more than I trust the stock market here in the short term.
For good reason, too, right? The bond market
and
vigilantes.
Here's the funny thing, too, and I shouldn't say it's funny, but now all of a sudden I'm starting to hear people that are always bullish and never change their mind when fundamentals change. And I'm always fundamentally based. So when I'm bullish, I have a reason to be bullish. But I'm starting to hear now, well, this time is different with the yield curve version. And to me, when I hear someone say this time is different, that's almost like the kiss of death.
Yeah.
You know, it's like when the real estate market bubble popped. Before the bubble popped, people were saying it's different this time because of the aging demographics. People are retiring and needing to buy these houses. To me, I don't think it's different this time.
Yeah, when has it ever been different, Eddie?
Well, exactly.
Yeah,
it's the last seven we've had, recessions we've had. When you look back on average of approximately 13 months, you can look back to a yield curve inversion. And that's where we are right now. It doesn't mean that one is imminent, but it means chances of one happening within the next year or so is very likely.
Pretty high, right? Pretty high. So
yes,
we know all this. You and I, we've been around the block a few times, right? And, you know, what are you supposed to do here? Just go into cash? Basically, that's
I think investors should have some cash in their portfolio. I think that's one of the most underutilized asset class that's never talked about. And what concerns me is, you know, people always follow the herd, right? And so they're seeing their equity prices just continue to go up and go up. And my concern is if they haven't rebalanced portfolios and now they're overweight equities because they've never rebalanced, when we do have a correction, they're setting themselves up for failure. So I think people who have not raised cash should have cash on the sidelines, should have fixed income. And on the equity side, I would focus on companies that don't have a lot of debt, maybe pay a nice dividend. And this way you hopefully have some protection in your portfolio, as well as some ammunition to buy the next major correction that we may see in the next couple of years.
And that sounds totally reasonable to me. You know, I just always think about what Bernard Baruch said. I got rich letting the other guy make the last 10%, right?
That's exactly right. I mean, I think right now, you know, in my book, The Common Sense Bull, I always talk about in that book how investors should put blinders on and just look at the fundamentals right now. And if anyone can just kind of put everything aside on what they're reading or whatnot, just take a common sense approach and say, okay, how much upside is left in this thing versus how much potential downside? I think one can make a very easy argument that there's probably more downside in the short term than any type of upside. So raising cash, I'd rather be early doing that than late.
Yeah, of course, because once the loss has happened, it's all your planning is for naught. It's too late. And especially for you out there, those of you out there who are older, who don't know that you can make that money back if you lose it this time. Caution should be the byword here.
Absolutely. I agree with you 100%.
Yeah. So, you know, are we in the ninth inning or the 10th inning? Or is it the 7th inning stretch?
You know, I would say we're in the 8th inning. Okay, I think there's a little bit left to go, but keep in mind, I think next year from an investment standpoint, forgetting all the other things we talked about, is going into an election year is going to be very challenging as well, too. As you know, the market reacts to headline risk, and I can't imagine what the headlines are going to be after every single debate and all the mudslinging that's going to happen and talks of taxes changing or not changing. There's a lot of things, again, when you look at trade, when you look at interest rates, when you look at an election year, that's going to cause quite a bit of volatility and uncertainty. And I just want to make sure that I have some protection for myself and for my clients, so that way I can hopefully take advantage of it when that opportunity presents itself. So I think we're definitely late innings. And right now, the market wants to see some type of major agreement with China in order for it to go up. And I just don't see that happening.
Yeah, I'm not seeing it either here. But then again, you never know. What's happening in Hong Kong, that's all part of the equation, but nobody really looks at them as being connected. But the two are very, very together here,
Yeah, I mean, the geopolitical environment is is on shaky ground. I mean, again, I'm not trying to be pessimistic. I'm focusing on fundamentals and being realistic. And this is probably the first time you've even heard me being this cautious and bearish in regards to the economy and stocks in the last few years. And it's because the underlying fundamentals have changed, and I'd be blind and doing people a disservice if I don't recognize that. And again, there's a saying that says the bond market is smarter than the stock market. And I happen to be one of those folks that believes that.
Yeah. Well, there's a lot to be said about it. And the stock market, you never know about the stock market, what it's really seeing. It's discounting the future, supposedly, but the bond market is more glued to the present, isn't it?
That is correct. And right now it's sending off a very cautionary sign that if an investor is not taking it serious, my concern is they'll possibly regret that down the road.
And for good reason, too. So caution really needs to be your byword here. Is there any particular indicator that you are looking at, Eddie, that you feel when it hits a certain point, this is it? You really need to, get out of Dodge?
I think the one thing that is left to drop for it to go from the last innings to game over is consumer confidence. Right now, when you look at everything, all of the positive numbers economically right now, I shouldn't say all, but what's making our economy strong and what has surprised to the upside is the strength of the consumer because of the tight labor market, because of the wage growth. And so 70% of our GDP is based off consumer spending. So as long as consumer spending stays strong, economically the numbers will look okay. But once that consumer confidence goes down, what happens. They just tighten up. They don't spend. And once you start to see those consumer confidence numbers goes down, I think that's the last leg of this bull market run and this economic expansion we've had here for well over 10 years.
Yeah, I think you're spot on, Eddie. We're going to be watching those consumer confidence numbers like a hawk. The problem is those numbers are lagging indicators, and you don't always know that consumer confidence has crashed until after it's crashed. And at that point, it's too late. So we have to pay strict attention, but be aware and be forewarned. Hey, Eddie, we want to find out more about you, get your book, read your work. Where do we go?
You can go to keyadvisorsgroupllc.com. And my book, you can get it on Amazon.com.
All right. Excellent. And we got a link to it in the show notes to this interview. Want questions, comments, feedback on Eddie's talk here, just email us kl@kerrylutz.com, Twitter feed @KerryLutz, Facebook page, Financial Survival Network. Don't forget to sign up for the newsletter. Eddie, always a pleasure. We'll talk to you again real soon.
Thank you so much for having me on your show.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.